All right. Hello, everyone. Welcome to another Pepperstone live event here on YouTube. We're excited today to bring you one of our favorite topics, and that's getting back to basics, bringing up the charts as what we call naked charts, Tyrone. How have you been this week? I'm excited to talk about markets because that's all at critical points and everything's starting to move, isn't it?
Absolutely. And I think, look, it's one of those really interesting topics as well. When you see the naked charts, a lot of people have a lot of problems actually deciphering them. And look, Tom, you've seen in the past as well, we've seen so many charts where there's so many indicators and lines on it, you can't even actually see price action moving. So it's going to be one of those things really, really important. And I'm really looking forward to bringing this to the audience, actually, because I think it's a very unknown concept that can actually be very powerful.
Just before we get started, Tyrone, I do have a quick disclaimer that, of course, we want to put through for today's video, but I also want to make sure everyone can hear us very clearly. We've just changed one thing in our audio setup, so I just wanted to make sure that's working. Please let us know in the chat. Aussie, we've got you there, and Roman, please just let us know. We'll go through the intro. We'll see you back in just a few seconds. All right, so we're back here. Well, Ty, today's topic, it's not just about naked charts. It's also about understanding some really important concepts. And we're actually going to have a little bit of a different mix up today, just to let everybody in the audience know. We'll go through two learning kind of concepts, which will probably take around 10 minutes each. Then we'll go into some live chart analysis and actually have a look at where we've seen some of these things apply over the recent weeks and recent days. And then, of course, we'll do the Q&A. So if you have questions, put them in the room. Tyrone and I always encourage a lot of conversation. We love answering questions out there and helping the community obviously understand things better, like the way we see things. And we also know that there's never a dumb question, is there, Ty? All questions are good.
Absolutely not.
I always believe there's amazing learning opportunities. If you've got a question, probably another 100 to 1,000 people have the same question realistically. Excellent. Audio is clear. So what will we be covering today? We'll be talking about why we use naked charts when finding price action trends. Then we'll be looking at how to identify these key levels using supply and demand theory and how to develop a trading plan along with our Q&A. So let's get into it straight away here, and we'll start with our first topic. So are you tired of using complicated indicators and confusing overlays when we're analyzing the markets? Well, it could be time to simplify your approach and embrace the power of naked charts. Now, Tyrone, I always believe that when we begin with naked charts, it's about the understanding of how price action actually moves. And I see it as the granddaddy of all of this was, of course, Richard Wyckoff. So what did Wyckoff tell us when it comes to understanding price action a little bit better? This is one of the quotes I always bring up. What do you think? What do you think of this one?
Well, Tom, your idol, Richard, actually likes to say that successful tape reading is the study of force. It basically requires the ability to judge which side has the greatest pulling power, and we have to decide that we have the courage to go with that side. And I think it's very, very important because sometimes people will look at a trend and say, I want to go against it. One of the things that, as well as I, people love to go against the trend, but you really have the courage to go with the side that's actually giving us the most pulling power.
Absolutely correct. And what Wyckoff did was he came up with kind of three main laws, and I think an overarching law that we'll talk about now. And what I want to do is focus on the first two in this particular segment. I want to talk about the law of supply and demand. And then I want to talk about, of course, his second one, which is cause and effect. So, Ty, what do you think about this? It's really just a life lesson, isn't it, when it comes to understanding demands and supplies? Throughout 2020, 2021, I think we've all become more aware of this with so many things shooting up due to inflation. But do you want to run through this for everybody so we better understand the concept?
Absolutely is. And look, demand is greater than supply, prices are going to rise. That's pretty straightforward. When demand is less than supply, prices are going to drop. And when, of course, demand equals supply, there's not going to be any significant price change. And, of course, that's going to mean lower volatility. Now, that's not just in the markets, right? We can see this even in the housing market. You can probably see that playing out all the time. Like if there's, a great deal of houses for sale, then obviously the supply is greater than the demand. Prices aren't going to be as great. They're going to probably drop, and vice versa. It's no different in the market. And it really does resonate. It's amazing. A lot of people will probably be seeing this happening literally as we speak, the last year especially, how supply and demand the laws of supply and demand have actually played out.
Yeah, we see it all over the place in so many of the different parts of the economy. And what he did was he gained this idea and started to get him thinking about how accumulation and distribution works in markets and how we can start to use the laws of cause and effect. And we're going to actually look at this on a chart, or at least a bit of an analysis very soon, where we look at this Wyckoff's second law. And Wyckoff's second law states that there's a difference between supply and demand. These are not random, but instead they came after periods of market preparation. In Wyckoff's terms, he basically said there is a period of potentially of accumulation, which is the cause, and that could lead to an upward trend movement or an effect. So effectively, we could see some form of market consolidation. And when it broke through, we would see the effect of this consolidation. And actually, it would show us that the largest players in the game within markets were actually driving a heavy position. It's vice versa for distribution, and we'll look at those very soon. So this brings us down to the way we simplify life. Ty, we start with naked charts for a very simple reason, and it's got to do with the composite man. We want to understand who has the greatest pulling power, and how do we do that? We simplify the market down to one entity. So what do you think about this concept of the composite man and how it can help traders?
Yeah, I think it's one we've talked about in the past, and I think it's a very important concept because we do really have to look at the market as a whole. A lot of people, I think sometimes people find themselves actually overanalyzing what's actually really going on. But when you take Wyckoff's idea and look at it as a single entity, I think it actually makes what can potentially happen a lot clearer. It's almost like when you're pulling in the naked charts, it's like the saying goes, you can't see the forest for the trees. And it's probably a very good example of what we're talking about when we're actually looking for patterns inside of a naked chart and really looking at the market as one entity.
Yeah, so when we understand it's one entity, then we can start to think about the way that markets are manipulated and better understanding that manipulation from the kind of price action standpoint. So what I've done here is I've put in an analysis example. Now, I've drawn this one before, but let's take a look at this. Let's assume we have a currency here, which is the Australian versus the US dollar. And this can work for any pair, whether it's a commodity, whether it's a stock, or whether it's, of course, a crypto. It's the same principle that there are larger players building and selling positions. Remember, no large player ever enters all of their position generally at once. They just wouldn't have the liquidity to do so, would they, Ty? I mean, we might as retail traders, but they're not going to be able to place their tens of billions of dollars into the market like the snap of a finger. It's going to take a little bit more time. So what actually happens is often markets will kind of like steamroll their way down into price. And there might be a point where a larger institution says, we're interested in buying a price. In this example, maybe they like to buy between 70 cents and 72 cents, with 72 cents being the premium price, that is an expensive price, 71 cents actually where they feel like fair value is, and then, of course, 70 cents is actually where they think it's cheap. Now, if you were a large player out there, Ty, which price would you rather get most of the time?
Well, you're always going to want to be the cheapest, of course, but that's going to be very rarely the case when you are trading with very big volumes. Like when you are placing trades like that. Look, in the Australian market, Thomas and I would tell you, and we've seen it plenty of times, that the market simply wouldn't even let you enter a really big position at one point because it has ways of scaring the market. Yeah, in trading stocks, you can actually see the volume. So if a volume line came up with, say, a $10 million order on a standard stock, which might be 20 or 30% of the whole volume for the day, the ASX simply wouldn't let you do it. It's just not going to happen. So realistically, it has to be entered in small positions. And of course, everybody wants the cheapest price, but at the end of the day, the big players don't want to be left behind either. So that's why they're going to basically, it's almost averaging down a position. You could almost call it the average down of a position, but taking it in the little slices that Thomas is talking about. And I think identifying those zones is key to what we're trying to talk about here.
So let's break down this chart a little bit more about understanding. So sometimes things will enter what they call capitulation. It looks like the end is upon us. Markets dump off. They hit a position. Sometimes it's the opposite way. And of course, it's moving up into distribution. Effectively, the market price or the price kind of falls to a level and then it enters that kind of cheap or fair value range. And all of a sudden, there are buyers that recommence in. So if you think about a bigger player, what they're going to do is they're going to say, I only want to buy it between this price and this price. And as it comes down to the cheaper end or the fair value, we'll increase our order size. And that's when they defend the position at those points. And what Wyckoff summarized was that this was the beginning of an accumulation position. effectively when it reached past the 72 cents in this case, sellers would recommit to the position, people would take profit, and basically the bigger players wouldn't be at that price anymore. It's above their premium range. They just don't want to buy it there, do they, Ty? They just give up.
Yep.
And that therefore reduces the demand. So we see demand, of course, dropping off, supply coming in, and it drops back. As it drops back to things like the fair value or things like the cheap price, we see spikes. And you've got to start thinking about this in the price action and the way that you look at naked charts, because how could they be represented in price? One of the most important things you could start to see is things like bullish hammers or wick style candles. Wicks often hold what we call orders. So they hold some of the biggest demand or supply when it comes to these markets. So basically, from just reading price action, we can understand a lot about this. They like this price, they don't mind this price, and they don't like at this stage the price above. So we're basically creating a position. As the market comes down to 70 cents, sometimes it will swing underneath these lows. And what that does is it creates what we call a stop loss hunt event. And these are very symptomatic of accumulation or distribution, effectively false breaks, which we can see as a naked chart trader on there. And we can actually take advantage of this by being nimbler and faster than they are, because we can enter whenever we want, Ty, and we don't have to necessarily place billions of positions. There's a certain point in time, especially over here, which we'll talk about is one of our price action naked sequences, that we can say, we see what they're doing and get involved in markets like here or even here, can't we? Yeah. So basically, that's something that we're always looking at, isn't it, Tyrone? When it comes to these particular charts, we're looking
Absolutely.
at these
And
prices.
one of the most important things about naked charts is obviously reading the price, right? And reading the price is going to involve looking at candles. A lot of people think that, a wiki sort of candle is really a nuisance candle that is difficult to assess. But realistically, in our world, a wick candle or a pin bar or basically a shooting star, you can call it the same thing, or a hammer, they're the most important candles that you're going to be looking for in these sorts of areas, because they're the ones that are giving you the most amount of information. So they can't be underestimated. It's very, very important to understand price action, because if you don't understand candle structure and price action, then naked charts aren't going to make much, I guess they're not going to make much sense to you, are they, Tom?
They're just really not. And it's these certain sequences that you're looking for to create replicatable trading positions. So if we think about naked trading price action sequences, we always know that markets will eventually turn. And there are basically three ways that markets turn, Tyrone. Today we discussed one of them, which is what I like to call the first time frame change of trend, or the fastest way for the market to build liquidity and to create a position. Because remember, it's all about creation of as much liquidity to get those billions of dollars stacked into the markets. So let's say we had a market coming down. We obviously have troughs, peaks, lower peaks, or lower lows and lower highs on the way down. Now, as we see this, what you'll see is you'll usually see a shift where that lower high or lower peak gets taken out, and suddenly we get a higher high or a higher peak. This basically means that we have most likely changed the trend on that particular time frame. And once that occurs, you can be kind of thinking, well, when we look at the left-hand side and we gain the evidence, and the evidence is key in naked charts, whether we have support, maybe we also have support here, whether we have demand here from previous price action, that's when we can start to say, maybe we can put two and two together and build a position. So if you think about it like over here, you might notice that there is a change here where we make a higher high, and that basically, therefore, after making that lower low, so that basically gives us the go ahead that this is most likely accumulation, and we have spotted the composite man placing large positions. So now we're looking for the effect, which in this case should be a bonanza. That's at least the theory behind this concept. So we really love that idea of switching trends, don't we, Ty?
Oh, most definitely. And hopefully people can see the importance of identifying that, because look, identifying a trend is obviously a very important thing, but what we're talking about here is really identifying that accumulation and distribution zones where you can actually trade inside that zone, not just automatically assume that a trend is going to continue, understanding what's actually happening through that price action. And this is why naked charts are very, very important, because sometimes if you have too many indicators on your chart, too many overlays, too many bits and pieces right there in front of you, you can't actually see what's really going on with price. And going back to basics is one of our favorite things. Like, I for one, look at the charts with no indicators on it first thing, and then start to apply indicators, because I don't want my judgment clouded by a 20 moving average or a 50 moving average crossover that actually might impair my vision to what's actually really going on. You could potentially miss a whole accumulation distribution zone just primarily by focusing on indicators. So it's not that indicators aren't important, but it's really important to understand that price action is king in trading, and understanding what's actually happening in the here and the now is the most important part of trading.
Yeah, and then we can bring it back to basically understanding when we look at this price, we got the most important indicator of them all, as Tyron was mentioning. So there is a couple of little traps when it comes to this naked price action sequence. We'll go through one right now. We're always wanting to see that previous high or peak taken out, or trough or taken out. Basically, the level of demand or supply, these levels must be taken out for us to see that first time frame change of trend. And that's what's really important about the sequencing that we've got here, and one of the creations that we're always looking for. So just remember this slide, remember the way that this is created, and think about it next time you're looking at price action. So yeah, Ty, that brings us, I guess, to our next creation area, which is, of course, understanding a little bit more about this distribution theory and accumulation theory. And what we're talking about now is supply and demand. So I think it's really this question needs to be asked. If you're tired of kind of guessing where markets are headed, it's time to start thinking about using supply and demand theory to identify your key levels. Let's now take a look at basically learning how to better understand both supply and demand, along with distribution and accumulation concepts of Wyckoff when it comes to these markets. And we'll go through that right now together. So Ty, basically accumulation or distribution, they're kind of the same as supply and demand, aren't they?
Yeah, they are. Yeah, absolutely. Look, it's a zone where the price action is actually, it's almost coming to a halt if you are looking at it from a momentum standpoint. Like, it could be trending up, then all of a sudden you get a bit of a pause in where the market's going, and you're going to see smaller highs and lows forming in what generally comes to a bit of a channel, or definitely a condensation pattern. When you start to see and identify that, it doesn't mean that you don't have to actually keep trading, right? The good thing about supply and demand zones is they open up a different element of how you can actually trade it. Yes, you may have to wait before the next move up, but there are other ways that you can actually trade inside that. When you know where the supply and demand zones are, or the distribution and accumulation zones are, you can actually take smaller trades inside those zones as well, depending on what time frame you're on. So understanding them and identifying them is super important, because it does give you the opportunities to trade two different ways. One with the trend when it does eventually start in either direction, but also to be able to apply your trading abilities to those zones.
Yeah, so we know when markets could become range bound. We also know when markets are theoretically at critical levels. So we can start to understand here how these kind of levels are arranged or are created. So effectively, as markets go up, often they'll leave behind price action. And that price action usually looks like a kind of compressed level, where basically there was a bit of sellers and buyers kind of having a fight. And they're fighting whether is demand going to outstrip supply, or is supply going to outstrip demand. Now, when markets come back to this level, it's effectively like kind of talking about a support or demand side. So let's now, instead of support or resistance from a trading perspective. So let's now take a look at this in a bit of retrospect here when we're talking about supply zones. Supply zones represent points where the banks and institutions have potentially placed significant numbers of sell positions. As the banks and institutions place many orders, they create what we call excess supply, and the results in generally a market moving lower. Now, because we know that's what's happening, if markets go back to this zone in the future, there is a decent chance, isn't there, Tyrone, that basically the banks will again instigate an excess supply. And it's very similar to resistance in this aspect, isn't it?
Absolutely. And when the two cross over and you identify that, that's where the real trading opportunity lies. And I think a lot of people miss that. They think they miss the initial move and they start to panic and they start to trade in the direction of that move, only to see the market reverse all the way back to the level where they probably wanted to enter in the first place. And then voila, it gets there. Then they go in the opposite direction, thinking it's going to go long from there. But in fact, that's actually the trap. And that's where the real trade is, because that's where it's almost a second touch of that resistance zone that you're being lured in.
Yeah, so you're pretty much being lured in when it comes to these positions, and basically the supply overall is something that we need to understand when we're looking at charts and we're taking advantage of these markets. We want to know where were the orders placed before, and therefore if markets go back to that area, what we're looking for is effectively the activation steps. So like anything in trading, it's not just using one concept, it's using multiple concepts together.
Yeah.
We want to use maybe anywhere between 3 and even 7 concepts. Not too many, but certainly not too low an amount. So let's talk about demand side. So demand zones represent points where the banks and institutions have placed significant numbers of buy positions. So often they'll look something like this. As banks and institutions place these orders, they sometimes create excess, which pushes it through that top end. And we've used these examples before. And this results in price reversing or moving higher. So effectively, this is something that often does occur when it comes to market creation. So these are effectively what we call the support of the supply demanding world, and you sometimes will see them overlap. Now, when you see support and resistance overlap with supply and demand, it further strengthens the concept that level is very strong. And that's, again, building confluence of two separate techniques together, isn't it, Ty?
It is. And I think that's probably the key word there too, Tom. When you're saying that you're using two forms of basically evidence together, it actually does help solidify which way your trade is going to go. And of course, understanding these zones, not only does it give you the opportunity to trade in the direction of where the break's going to be, but probably just as importantly, and probably a very overlooked thing, is actually knowing where to put your stop losses as well, because it allows you to put a relatively conservative stop loss, but that's fairly close to the price action, which makes, of course, the returns on these trades when they do move out a lot bigger. The risk reward is generally a very generous reward versus the risk, because you understand the zone.
Yeah, so it's a risk reward's a great standpoint. This is the thing that we're all looking for. We want 4 to 1, 10 to 1, at least over 1 to 1 when it comes to ratio. And what I mean by that is if you're risking like $100, then you probably want to be trying to make at least $100 from that trade. But we need to be market adaptive. We need to understand where are these supply and demand zones forming. And therefore, when we move from one, I like to think of it like equilibrium. If we've built a position and then we're moving up, that is of course, in this case, the effect of building the position. We're generally moving towards the next equilibrium of price. So let's think about just supply and demand just a little bit more basically. Let's understand this together. Changes in supply and demand only happen when big traders buy or sell. When prices fall, supply probably will outweigh demand in that case. Retail traders, we're the small fish. We can't make the price rise or fall generally. There are some exceptions to the rule. Of course, GameStop, AMC, and some of those others that happened in 2021. However, in general terms, that's not what happens. And of course, in whether you're trading Forex, commodity stocks, or any of these things, banks and institutions place their positions over a long time. So they continuously keep placing them. And what we need to understand from all of this is that they need to push price around. So basically, price will be often looking highs and give a lot of false breakouts. And they'll do that to induce liquidity, to induce you to potentially trade those positions. How I like to think of it, Ty, and this is one of the best concepts, I think, is I say patience, react, don't predict. So maybe it's better we don't predict that the market is creating a supply or demand zone. And instead, what we do when we're thinking about naked chart analysis is we say, once we've seen a supply zone formed, if markets return back to that level, what's to make us believe that there isn't going to be a big spike in activity from these larger banks and institutions? They generally will have a go at the level again because they did before. That's usually the theory, isn't it?
Yeah, 100%. Look, and as much as Richard Wyckoff is Thomas's idol, I'd like to think that in 80 years' time, people are going to have a picture of Thomas on their wall, and his quote's going to be that patience react, don't predict is going to be his catch call. And someone will be saying that in a webinar, because that really can't be underestimated. You must really, really use those, put them on your wall and actually stick them up there so you see them every day. Because I think one of the biggest failings of most traders, whether they're actually starting out or even sometimes semi-professional or even professional, is that they actually do try to predict the market rather than react and be patient towards it, because it is a real failing of many a good trader. So it's one thing that you want to be, you want to have that in your front and center of your mind, have it on your wall, because it's very, very important. And it may just save you from placing an erratic trade or a FOMO trade, just by knowing and understanding that patience is key.
It really is key. And we can actually, you always ask yourself this question. I've asked it many times. If I had been, like, you look at a trade, sometimes you'll get in early and you'll find that it just sits around that price and it just continues to sit there. And then all of a sudden it makes a move the wrong way. It would have almost hit stop losses if you weren't maybe a little bit more aware of the market. And then it gets another entry and another entry at that price. Then it goes in the direction you wanted to. And the trick is actually surviving all of those hits. So sometimes it's actually better to come in once you've seen something create and you start to spot the market and its prediction of what it's doing, so you can react to it. So here's just a great chance of seeing demand zones when it comes to naked chart analysis. There's no indicators here. It's super simple. And what it is, it's a creation of basically a level. And if we think about it, here is the cheap price. Here is the fair value price, and here is the premium price. Someone has been building a position. Now, we know that position's been built because it's broken through to the top end, and therefore buyers have committed themselves. But what you might notice here is that we get a lot of wicks created at the cheap price. That is the low down here. Now, wicks hold orders, don't they, Tyrone? And that means that there is some big institutional player, or whoever we want to call it, the composite man, they're sitting there, they're excited about that price. And that's represented in these wicks at that level, isn't it?
The wicks tell you so much about the market that you probably don't realize when you do understand what you're looking for. When they're all forming, look, a wick in the middle of nowhere is basically a nothing candle. We've said that many times. But a series of wicks at a particular area is extraordinarily important. And that's building the case for what's actually happening. Like Tom said, the wicks are going to be where that cheap element of the zone is. And basically, then you're going to work up from there. But the very bottom of those wicks, the market's reacting from those levels for a reason. Like, it's shooting up and not holding down and closing at those levels for a very, very good reason. And understanding that is key to getting into some of the best prices. There's no question about that. We're very wick happy.
Yeah, well, exactly. And standard kind of resistance support theory would have you believe that, of course, if we think about it, resistance is up here. And what's going to happen is markets will return back to that level. And often you'll see what we call role reversal, which is basically where the market will buy up. And that's okay for a swing trader. But when it comes to scalping, looking at naked charts and understanding markets better, you've got to think of this as an entire position was built through that price. So what we're interested in actually seeing is more of the fair value and potentially even the cheap range. And you'll often see the market come further in and either turn in this area or this area. And it does so because it's entered a fair price. It's entered the price that was probably the most traded, and the market, the larger institutions have come in, they've swept in, and they're ready to purchase. And they go bam. And then all of a sudden it's like a slingshot coming away. The problem is, if you don't recognize that it's actually within price that might be the best order, sometimes your stop losses can be hit. And then, of course, that can be very detrimental to your trading. So when we're understanding supply and demand, or understanding any of these things, it's important to also come back to, when is going to be the best time to see these potential breakouts of supply and demand, and therefore seeing the effect of those builds. Well, generally traps are set around opens as far as we look at it, Ty, and the actual effect of the move often happens about 30 minutes to even 1 hour after the open. So we particularly love the London and the US sessions, don't we? And they're great for lots of pairs. What do you think about these two?
That's where you're going to see the most amount of action. There's no question. And look, a lot of people are scared of market opens because they think that they're going to be faked out and all manner of things that are going to happen. But in reality, if you understand where the zones are, openings are going to be your friends, because that's where you're going to see the most liquidity sort of kick in. Especially, a lot of people just trade the open. You've got to remember that. And look, London and New York are highly liquid times in nearly every market in the world. Like, you're going to get that in currencies, you're going to get that in indices, you're going to see the biggest moves in those times. And of course, we want to be involved in the market at the time when the market is actually moving on real volume, not just speculative volume or very low liquidity times where you can see gapping and things like that. What you really want to see is stability in the market. When a market's moving with force and it's got volume backing up that force, it makes it a hell of a lot easier to trade, and it's far more reliable as well, right? So that's what you've got to understand. Understanding which market you are trading relative to the instrument that you're trading is very, very important. If you're going to have your second chart on the wall, I would probably suggest the market opens and the times are probably the one you'd really want up there.
Yeah, I think a lot of breaks happen around opens, and the first half an hour before is a great time to come in.
100%.
To around 1 to 1.5 hours after. That's the if I was to say scalp times of the day, absolutely. Now, I've written a couple of things here as a bit of a cheat sheet for you all. So we've got commodities and currencies often do great in London session. We've got commodities and Asian pairs in particular, obviously makes sense for the Asian session. And then the US session is kind of like a free for all. I think it's stocks, indices, commodities, currencies. I don't think it matters. We just throw it all at the charts at these points because realistically, that's when you get the biggest amount of liquidity. And of course, this brings us to the pairs that you should begin with, potentially as a beginner or even intermediate. When you understand supply and demand, you start to think about it as, okay, well, we need the biggest institutions to be placing lots of orders so we can see what they're doing. Now, what are they going to be placing the most amount of positions in? The most liquid pairs. So I think it's always great to stay with the most liquid pairs, especially at the beginning, as they tend to trade the most technically. And you can be nimble and fast within a sea of, I guess they call them whales nowadays. So we can be the Wyckoff's concept of the composite man has become, the concept of whales. So we're interested in where those whales are, and we want to be, of course, joining in with the whales. So I think that's really, really important when it comes to the markets. So that, I guess, gets us through the theory components. And now what we want to be doing is going into some of the charts. So if you have questions, feel free to bring them through right now. We do have plenty of you in the chat. Make sure to smash that like button as well if you enjoyed that content. And I'm sure you might see it over here on YouTube again, so you can rewatch that and get through it. Now, one of the things I will state is that I really think that volume profile is an exceptionally good tool to come along with both concepts that we've talked about so far today. Ty, I love knowing where the big positions are, and volume profile is a game changer over the last couple of years, isn't it?
It most definitely is. And look, we've done videos on this. I would suggest, if you don't know what we're talking about when it comes to volume profile, we can only cover so much in today's video. But look, we've done extensive webinars in the Pepperstone YouTube channel on volume profile. And if you need to know more about it or you don't understand what it is, certainly check some of those out.
Yeah, definitely check them out in the Pepperstone platform. So let's go over here to a chart of the US 500, because there has been a little bit more activity. Basically, the VIX, or the volatility index, is pretty much as low as I've seen it in like 2 years. I think, in fact, it is extremely low. Like, if we load up the VIX here, where's my VIX? Here's the VIX. You can see that it's getting down there, and it just started spiking up. Now, a lot of this has to do with something we call the VIX pin, which has got to do with gamma. But outside of that, what we're really looking for here is an increased amount of volatility coming into a pretty big earnings report, which is, of course, Tesla, that comes out in a few more hours, or at the end of the day, I think. And then if we look over here on the daily, what you might notice is that from a scalping or naked chart perspective, I want everyone in the chat actually to answer this. What area did we enter into recently? Is it supply or is it demand? So let me know in the chat what your thought processes are, while Tyron and I rant on about dojis. What is a doji candle, Ty? And what does it mean for us as traders, investors, everything like that? What do we need to be paying attention to?
I'd start out by saying that a doji candle in the middle of nowhere is just that, in the middle of nowhere and useless. But a doji candle in an area of supply and demand is extraordinarily important, because what that's showing is a balance of buying and selling pressure. Now, the bigger the lines on either side of the body, which is of course the body's going to be made up of the open and the close, whatever time frame you're looking at. So in this instance, we're obviously talking about a daily chart. So we're talking about the open and the close of that price action throughout that day. But the wicks on either side of the body are telling us the price action that was actually reached throughout that day. Okay, now in the middle of nowhere, it's pointless to even look at it. But at an area where you know there's been previous resistance, it's extraordinarily important, because what you could be picking up is those cheap selling prices that Thomas was talking about there at the very top of that doji candle. Okay, so very, very important. For those of you, so we've got a lot of supplies coming in as the answers, which is great. But yeah, look, a doji candle in a supply zone is telling us a lot about the market. In fact, it's telling us all the information we need to know. It's actually verifying and validating that we are in the correct area and we've identified the area correctly. So in terms of although it's an indecision candle as such, because the opening and the close is very close to each other, and it saw a lot of price action either side of that, it's actually confirming in a way what we kind of are hoping to know, is that we are in a supply zone.
Yeah, we're absolutely in a supply zone. Now, just because you're in a supply zone doesn't mean that, of course, you're going to instantly activate shorts. If you're going to do something like that, there's a certain level of risk when it comes to that one. However, it can mean that you are looking maybe at, well, you can think about two things. If you were long, would you be potentially thinking about TPs or descaling your position? I mean, it would make some sense. If you are a scalper or a day trader, you're looking for signs of either breaching this supply, which probably leads on to a further effect, because of course, in this case, it would move to the next level of equilibrium. You'd want to go do some naked chart analysis to figure out where you think that's going to be, or you'd be looking for turn points. So if we actually scroll down here and we go to less than 24 hours ago, you might notice that the market comes out pretty aggressively, and there was actually a gap. So what a gap is it's the difference between the previous close of the day and then the next open. And what that usually means is the futures market have made a large move. So in this case, what happens was the futures market went up. It was up about 0.5%. And it doesn't really matter whether this is, again, an index or a commodity or a crypto or a currency. It's the same principle. And then what happens in this case, though, is we have that gap. So what a lot of people believe is that we should fill gaps. And there's a certain percentage, I don't know if it's like between 20 and 30 something percent of all gaps are filled within the same day. So what that means is that markets effectively will fill a position, and they will do it fairly quickly. Now, you may notice that as it gets into this extreme wick range, which on the higher time frames we know to be usually a supply zone, we get a little bit of a change of trend. So that's that high, low, higher high, and then a lower low. We haven't had that sequence anyway through this. And all of a sudden, that brings the pain train. The market comes back down and it fills all the way back down to the gap level. Now, there's a certain way of doing this. We certainly do teach it over at fxevolution.com if you're ever interested. It's called our Advanced Scalping Masterclass, or soon to be renamed, I guess, Day Trading in Advanced, because it's the same thing. But realistically, this is a very conceptually good concept, because what it does, it gives you kind of activation within an overarching higher time frame supply or demand zone. And that should be something that kind of excites you as traders, because I know it excites me, Ty. I always get excited.
We certainly get excited about it, Tom.
I also get excited about a bit of volatility coming back into the market. You know, crypto was quite a lot higher. Bitcoin was sitting at like that 30,000 300, which is a zone I've looked at for a long time. Got a little bit higher, and now it's taking a little bit of a hit. So it's an exciting time because volatility is finally spiking after being a bit boring for a while. So we get that kind of change over here. And it's a big deal. And we get, of course, a lot of other things going on right now. We've had like kind of trend lines through the bottom here. They've been breached. We've now created new supplies, which you can see on the smaller time frames. So if markets come back up into these zones, you might want to look at smaller time frames. That's the beauty of technical analysis. We obviously are given information, and what we're doing is we're trying to dissect that information on these charts to create a storyline that makes sense to that basic principle we talked about today, Wyckoff's concept. Fair value, I break it down this way: premium, fair value, cheap. When markets enter those zones, if you see a reaction, then you can say, I know what's happening here. At least that gives you a better understanding than just being like, hey, YOLO, let's go in on these things. At least you get it a bit more of an evidence-based approach. And I think that's something really important. It is usually better to react, don't predict. And Ty, I've got some people in here we've seen before, and I want to ask them the question, maybe Warwick and a few others. Do you believe that when you start to have that patience, because it's always helpful to see this, have you noticed that when you have the patience and you react to the position, do you place better positions? Let the people in the comments know, because it does help out. Bill asks here, do you play gaps? Yeah, gaps are a consideration. So it's like anything. You would build a level of confluence, wouldn't you, Ty? And gaps might be one of your 7 or 8 reasons, correct?
Yeah, 100%. It's one of those things that you don't automatically just trade a gap because you see it. It has to make sense in the bigger picture. It's really, really important that it actually makes sense from a standpoint that oil is probably a good example of that. We saw the really big gapping effect that happened about a week and a half ago, where it all of a sudden like rose, $5 or $6. You don't automatically just trade that because this is what that's what a gap would entail. Okay, is it on the?
Are you talking about oil? Yeah. Talking about oil?
Yes.
Which one? Yeah. So you're not going to. I don't know why I don't see it here. But basically, yeah, there's a huge split in this area here.
There is a huge split. I'm not sure why that candle's there. It's not supposed to be.
No, it's because of the weekly. 1 second there. No, it should be there. Anyway, it's there now. But yeah, there's a huge split here in terms of a gap that should be there. But another example that we can use is the SPX here. And what you might notice is that we have tons of gaps. So it's the same thing. We've got 1, 2, 3. I think there's 4 sitting there, and the market's way higher. So it doesn't necessarily mean, the gap's going to fill, as Tyron's saying. It's just a weight of evidence that you're looking for. So if you start to stack those separate concepts in whatever they might be, then you can start to build a better position for sure. Warwick here says 100% to the question before about being more patient. That's good. And Blake Callan says, patience has been my most valuable improvement. I don't have to get back that which I don't lose. Oh, that's a good comment. In fact, I would, I don't think I can highlight it, but I certainly would like to highlight that comment. That's a sick comment.
It's a great comment. It's a very, very good comment. And it's actually a number one rule, and it's probably one of those ones where, you hear us talking about never wanting to revenge trade. It's one of those things where you do revenge trade. It's a trade that you've got to get back when you place a bad one. And patience does keep you out of a lot of bad trades because you've got either a fear of missing out, or you feel like you need to hit some sort of quota for the day or week or whatever it is. All those sorts of things have to be ironed out of your trading concept, because really being patient, by the way, may mean that you don't actually place a trade, right? Like that's probably something we need to highlight. It sometimes means that you'll go a day without trading or a couple of days without trading simply because the market and the setup is not there. But again, you don't want to be getting lucky in trading. You want to be trading with a strategy. I think, you want to avoid the, trading for the sake of trading and hoping you get lucky. That's not really trading, right? That's a hobby. That's bingo.
That is bingo. We don't like doing bingo. I don't think I'd ever win at that game, to be honest. But anyway, let's have a talk about this question. So we've got a couple of questions going. How can we use volume? Well, I'd have to suggest looking at the Pepperstone videos we've done over the last couple of weeks. We really talk about volume profile quite a lot, which is a big thing. But in general, you want to kind of get away nowadays from using just horizontal, just the normal volume. This is great when you're looking for distribution or accumulation because you're trying to build a position. And it's particularly good when you're on a daily plus time frame. However, if you're on a faster, more nimble time frame, you'll want to use fixed range volume profiles. So if you actually pull a directional area, you can find where the biggest amount of transactions have gone through. And that is the way that you want to be using volume nowadays. It's a very powerful tool, and it is available to Pepperstone clients. You can get it through, well, actually, I think it might be a paid service through TradingView, but I think there's even one in MetaTrader 4 now, Ty, or MetaTrader 5, my mistake. And you can obviously use TradingView through Pepperstone So that will at least enable you to be able to do the analysis through the charts. So you can see here that through this entire build, the most traded zone actually was 4,100. So that was the most transacted zone. So maybe the market may want to move to this area where it finds maybe some buying demand because, well, we can assume that because the trade was up, that there's something there. Again, it's about stacking confluence. So that's one of the reasons. And I particularly do like the volume profile. There's another one that's quite good, which is called volume profile for the session, which just gives you the previous sessions on the chart. That is the previous trade day. So kind of like the Asian, London, and New York session, compiles them and says, where's the most traded zone of that session? And that can be a helpful concept of adding volume. Volume is a complex matter, though, so we'll probably cover it in the future at some point. Warwick says here, get a bad trade, shut down, come back tomorrow. Yes, that's also a great way. Having a stopgap is always important when it comes to these markets. So that's a good one here.
Yeah, probably just on that, Warwick, I'd probably go as far to say is if you're trading correctly with the with all of the right parameters in place, there are no really bad trades. It's actually just a trade that hasn't worked out. In my mind, the way we consider a bad trade a trade where you've actually made a mistake and haven't done the analysis right. I think if you have done all the analysis correct and it hasn't worked out, that's not really a bad trade. It's just a trade because not every trade is going to work out regardless. So you probably want to just remember that if you've done all the right things and you haven't made an error in the way you've set up that trade and it hasn't worked out, you really shouldn't be holding that against your trading strategy. That's for sure, because not every single trade is going to work out.
So we've got here, Bascreate says, is it free or do we have to buy the basic trading view plan? I think it's on one of the trading view plans. Might be pro, Bascreate. But again, there is a plugin, I think, for MetaTrader 5. Maybe someone can find it. You can search it online, maybe volume profile, or possibly even ask someone at Pepperstone. Maybe they know. I don't know, but I'm pretty sure there is one. Trish OD says, I've started using volume profiling after listening to your webinars. It's been excellent. It can give you more clarity in an unclear situation. And I think that's the big thing. We're all trying to understand this beast that is this market. It's very difficult to understand. This is not easy. It may seem easy because it's easy to press buy, sell, or put a stop loss in and do the roulette type. But really what we're doing is we're trying to understand the dynamics. And I think today we've covered one of the most important topics of naked charts, which is to understand that positions are built over time. And once you start thinking about markets that way, I'm telling you, it will change your opinion on markets. If you're interested in that type of stuff, you can always jump on over to, obviously, our website as well, fxevolution.com. And I'd highly suggest you at least consider potentially our advanced scalping masterclass, because it uncovers this and it keeps building on that position. And I can see there's a few people in the chat that have done it tonight. They obviously like it, I hope. Well, I know a few of them do. So yeah, basically that's kind of this today's session. We want to talk about those two major concepts. If you take something away, I always think about it as big ideas, Ty. And I think the big ideas from today's session, to me anyway, maybe they're not to you, but to me, would be thinking about big institutions placing positions, fair value, cheap premium, great way to think about things, and also building positions quickly. How does that represent in price action? Is it always this type of thing, or is it sometimes that faster way that we spoke about before? Believe me, these types of things really do make a big difference. And we've actually talked about two ways trends change. There is the parabolic version, but we won't go through that today. We don't want to talk about parabolic all the time because it's not always going to happen in markets.
No. The original Bitcoin says, I'm still all over the shop, not taking any trades as too much patience. Well, look, you know what? While you're learning the trade, while you're learning the process, you can never have too much patience in our book. And look, the market's not going anywhere. In fact, It's getting better. And we can see, if you ask Thomas and I's personal opinion, we're going to tell you that, we really believe that over the next 3 to 5 years in particular, markets are going to go to the next level. And I think that trading opportunities are going to be better. Even if the technology is available now, this wasn't even available 3 years ago, let alone 3 months ago. So
not easily.
I can only imagine what's going to be available to us in the next year or two. And I think the markets are really expanding and developing. There's nearly nothing that you can't trade now, and the opportunities are going to be better. So our advice would be not to rush. Learn the process, understand. learn what you're trading before you start trading, and then everything will make a lot more sense to you. But don't punish yourself for being too patient, because patience is key regardless. And don't worry too much about not placing trades in the interim, because the markets are not going anywhere.
Yeah, there's still quite a lot of time, I think, for for you to learn the markets and to obviously understand them better. And things will change, but at the same time, they'll stay pretty similar as well. They have really, and I guess I'm approaching a long time in the markets now. It's actually longer than I was just about to say. It's probably about 16 years. So it's been a while now. I might look young, but damn, I've been doing this for a while. So this is
we've been doing this combined for a long time, Thomas.
Yeah. It's a combined 30, actually probably like 38 years of experience or whatever we say, Ty. Anyway, it doesn't really matter. The point is that it's always exciting. We're still super passionate about the game because it's so fun. We hope you found a lot of value in today's session and you enjoyed the webinar. If you did, or the live session here on YouTube, if you did, smash the thumbs up button. It does help us out. Join us in only a few weeks' time when we go through some other topics. And I think we'll really go through enriching you guys with extra learning experiences at the start. And then, of course, at the end, we'll go through some live analysis and actually talking about the market, maybe a way of applying that. I think that's good. If you do like it, let us know in the comments. Thanks so much, everybody. We'll see you in a couple of weeks. And we wish you all the best in what could be increased volatility coming back in. The VIX was low, Ty. Maybe it's going to spike today.
Absolutely. Thanks, everyone.
All right. Thank you. Bye for now.